Hello, everyone, and welcome to this Forex session. And of course, thank you for your patience. As always, David and I are usually tripped up by something very, very silly. It was a problem with talking to each other on our headsets. Anyway, it's all sorted out. And as I said, thank you for your patience, and thank you so much for taking the time out to come and join us this morning, as it is here in the UK. It's lovely to have you with us. But before we start, as usual, may I just draw your attention to the disclaimer that I know you can see on your screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. Okay, we've been away for a little while, busy on primarily the stock trading and investing program. Those of you who follow me on Twitter will know that that's where I keep everyone up to date more with basically what is going on in the market. And if you want more specific Forex analysis, you can always catch my posts on the Facebook page, which is actually called Learn Forex Trading. It's facebook.com/Learn Forex Trading. Please be aware that there are a lot of fake pages that have been set up using the front page of my various pages. And the only way you can check is you have to look at the URL. The URL should say full Forex. My Forex page is, as I said, Learn Forex Trading. I don't ask for money. I don't ask for anything from the followers of my pages. So if anybody ever asks you for anything, specifically money, please just ignore them. And if you can drop me a little message, and then I will contact Meta, Facebook, and try and get them taken down. Although so far there are two persistent ones on Facebook, and it's really, really difficult. Nothing seems to have been done. There is the same problem on X, aka Twitter. I have a very live account, which has got about 20, I don't think it's quite 21,000 followers. So that's definitely me. There is a semi-dormant account, which I set up purely for Forex, and I've just let it, parked it to one side for the time being. Once we've sorted the stock program out, I'll sort my social media channels, as it were. But apparently there are about 7 fake accounts. And again, I don't ask for anything. I don't request money. I don't request, the only sign-ups I offer are sign-ups to the Forex program, or you will get a link to the Forex trading program, which I know we've got some of our students here today. So I just wanted to clarify that. And of course, if you come across any others, please, as I said, just let me know, because the world is full of scamsters, and I really don't like to see people taken advantage of. Okay, let me just bring up the MT4. There we are. What we're going to look at today, well, what I'm going to look at in particular, I know David's got some other bits and pieces as well, is I want to have a quick look at the dollar and its relationship with with bonds, and also at the Japanese yen. Now, the backstory to the Japanese yen, as you know, if you follow your news feeds, is the Bank of Japan is very concerned about the weakness of the yen. That is primarily reflected in the dollar-yen exchange rate. And the key number is 150. They are getting very, very nervous. And the reason they're getting very, very nervous is, having spent the last 25 years, David, 30 years doing QE, because they wanted to inject some inflation into the economy. They've been by issuing loads and loads of bonds. Now that inflation has come knocking on the door, they're all panicking like mad because the yen is so weak. Because when you have a weak currency, if you are in an inflationary environment, that is going to aggravate it. Central banks have got this fixation about 2%. I'm not really sure where that number comes from. I don't think anybody knows where, but it is what it is. So we have to work with it as traders. And this is what they, this is what they have, if you like, nailed their colours, nailed their colours to the mast to this 2%. So everything revolves, every action, it revolves around the 2%. Whether the 2% is reasonable, why can't it be 3%? Why can't it be 1.5? Why can't it be 4.5? Who knows? Anyway, as I said, we work with what we have, what we are given from the central banks. Now in Japan, inflation has crept into the system. It's also been accompanied by a weak and a sharply weakening currency. They are now panicked out beyond all control. And the way they're trying to do it is they try and control what is called the yield curve, the YCC. So if you've not come across these relationships in the Forex market, in this market and other markets, the relationships that exist, the correlations, the relationships, I said, between different markets and instruments, you will find it detailed on one of the books on Amazon. It's obviously covered in our Forex trading program. But you can just Google it. You can look it up. Just educate yourself why the market is so concerned about this particular narrative, because the markets, if you want to give explain the markets to people, it's about stories, it's about narratives, and it's the narrative that we have that reflects the current economic cycle, the current business cycle. So obviously inflation is very much top of everybody's list. Going back to the yen, what has happened, as we can see here over on the matrix, this is the hourly matrix, and we can see here also on the hourly CSI, it is still falling. So from a trading perspective, that is the backstory. What this tells you from a chart and a technical perspective is that if the yen pairs are all doing this and they're all moving in one direction, then that is where you are going to find some really nice trades. And the pair I want to take a look at is, in fact, the pound yen, which I will do after I pass on to David. I just want to cover sort of general things first, pass over to David, and then come back, because I also want to talk about the dollar, and in particular the dollar index that we have here. And this is the daily chart, and as we can see here, it's been in congestion. It's been oscillating around the volume point of control here for some considerable time. We're back to September. You've seen failed attempts to break to the upside, break to the downside, and back it goes, as it were. And this is a great visual representation of the Wyckoff second law of cause and effect. And it's basically the cause is the consolidation, the oscillation, if you like, around this area of the chart. This happens to be based on our volume point of control indicator. It's the area of the chart where price has been transacted over the longest period of time. And it's also a great example of why a lot of traders don't like trading breakouts, because you can see how many fake outs there have been. You can see it here. There was you can see it. There was one there, went back, and it's to both sides. You don't need me to go through every single one. Then we had here the one that looked like the most promising before it retreated, it snapped back. Although interestingly, it didn't actually get to the VPOC itself, which is actually quite important. It's only maybe only a small point, but it possibly could be telling you that possibly, not obviously this time it didn't happen, but maybe the next time. Because for me, if you like a genuine fake out, well, that sounds a bit counterintuitive, as it were. What you want is it goes back into this very, very tight zone that we have around the volume point of control. It didn't here, so maybe that's an interesting observation, if you like. Obviously, you have to keep an eye on the dollar, because if you're trading the majors, what is happening on the DXY is going to impact the major pairs. Although you do have to bear in mind that the DXY is not an equal weight in terms of its calculation against the other pairs. The biggest weight you have in there is the euro dollar, and I don't even has the Aussie, the DXY that we all use. However, having said that, you do get this relationship between the DXY and the majors. You'll obviously get a very close relationship with the euro dollar and to some extent the pound dollar as well. And in fact, we then did have we've had a very big breakout last week, which was on the CPI. Now, with a falling dollar, what is the relationship? What relationship does the dollar have at the moment to other instruments? And the main relationship is to bond yields. Bond yields are also having a very close relationship with what happens in the equity market. So therefore, the inflation data comes in. CPI was a little bit better, nothing major, but it was enough, because when the market is in one of its stories, if you like, narratives, if you like, it's fixated on one type of fundamental news, the reaction you will get tends to be outsized to what the data is actually signaling. If you like, it will latch on to every tiny bit of good news. So that is the reaction in the thing. We had a push up in the indices, bond yields fell, and that then has the knock-on effect on the pairs that you may or may not be trading. If we go back to, this is actually on my Trading View platform, where I use another version of the dollar index here. Let's have a look. Let's just move that to the daily chart we have here. And as I wrote, I put this chart up on my main Twitter feed. I don't usually put a lot of Forex stuff on there, although the front page of my profile says that, it does stress the Forex market. I actually talk more about the general market and the ETFs, the SPYs, and individual stocks. Anyway, but we can see here, we can see this in more graphically, because we've got the accumulation and distribution indicator, which we can't have on MT4. The indicator we have there is only on solid lines or very faint hatch lines to give us an indication of how strong that support or resistance is. And you can see here the strength of this, let's call it a price channel, if you like. We can see here again this failure that we have here. We go back, we don't touch the volume point of control, and in fact, the following day we get the pivot. Now the pivots are fantastic, because the pivot indicator is such a simple little indicator, but what it tells you, what it can help you with, is when a price action is going into one of these congestion phases. It marks the top and the bottom of the congestion. It's very well explained in our books, the complete guide to Forex, a complete guide to volume price analysis, and also Forex for beginners. And I think that's one of the real strengths of the pivot indicator. It helps us to give some geometry, some shape to the chart that we're looking at. If we move back here, we can see this tremendous trend that the DXY was in. It went up, there was a pivot, and then very soon afterwards we get a pivot to the downside, then it up. And as soon as you see almost three of them like that triggered, you kind of think, well, maybe we're going into some kind of sideways. And at the same time, when we then start to build these platforms of support and ceilings of resistance. If we move over here, you can see a very smaller version of this congestion phase. Now, the issue, the thing about the second law, the cause and effect, is the longer this price action, whether it's the DXY or anything, stays in this congestion, when you do get the breakout, it's going to be pretty explosive, and it's going to have a lot of energy behind it. And in fact, this is the one. This is the CPI one. But what's interesting is also triggered the volatility candle, and the volume underneath it, yeah, it was good volume, but you know, but it was the candle and volume didn't really agree. So what that tells us is we are probably not going to see a follow through straight away, and we didn't. We actually had a reversal back in. So as a day trader, if you're only trading on an intraday basis, you really want to be able to try and establish what the trend of the day is going to be. So looking at the daily chart, when you do have this explosive price action, will give you a bit of a clue. And then what happens is you get a lot of volume coming in, a lot of volume coming in there, but the candles are very small. You know, all the time we're looking in VPA, we're looking for anomalies. We're looking to see whether the price action is genuine and whether the volume is genuine. Whether the price action is genuine, and is it supported by the volume that we see that accompanies. And in fact, we did have a continuation. And the final thing about breakouts is I can see why traders don't like to trade them, because the longer you're in one of these phases of consolidation, it can be very, very frustrating. I mean, other traders say, well, you know, if you're swing, you've got these very strong levels, then there's nothing wrong with taking the trades within the price channel. To get over the criticism, or the maybe not criticism, but the observation that you do get a lot of fake outs, and you can do. Therefore, you are going to perhaps potentially be facing a lot of losing trades. The one advantage of having a consolidation phase, very strong levels of resistance and support, is where you place your stop loss. It can be very, very tight. And if you're wrong, so what? You haven't lost very much and you live to fight another day. So there are advantages of looking at consolidation phases and actually using their perceived disadvantages to your advantage, and one of them, a very strong one, is, as I said, the stop loss, because once it does get moving, once you do get a trend move away, particularly if it's been a long consolidation, you could end up with a very, very, very strong move. Going back to relationships with the dollar, what I also have here, when I said about bonds, the bond market rules everything because it's the price of money. Now, I actually have here the 2-year bond. The benchmark for the cost of money, the debt, if you like, is the 10-year bond. But I know the Fed, because they've said it, are keeping a very close eye on the 18 months and the 2-year yield, because they're not really looking, it can't really look more ahead than that. I mean, nobody knows what's going to happen in the next 2 to 3 years. So, but the 2-year is not too close, like the short, you know, the monthly ones, and not too far ahead. I think, although the 10-year, as I said, it's like an international benchmark for the price of money, and by that I mean the cost of your mortgage and the cost of your credit card. And if we look at the consolidation phase that we have had in the 2-year yield, and we look at the DXY, there is a similarity. It is going sideways as the market really tries to make up its mind whether inflation yields are going to come down, or inflation is going to come back into the system, and therefore yields will go higher. Markets are, from a trading perspective, you just trade what you see on the screen. But from a general overall, what is going to happen, it's not clear. What longer term, is there going to be a recession? Is there not going to be a recession? So everyone looks at those instruments that are going to give clues, bond yields being one of them. And for us as Forex traders, we know that the dollar has a close relationship to bond yield, so it is in our interest to pay attention to what the bond market is saying. And as I've said many times in many posts and on many Twitter tweets, or I don't know what you call them these days, to most people, when the bond market is mentioned, eyes glaze over because they think, oh, I can never understand it. It's so complicated. But actually, it's really very straightforward. And this is, in many ways, the most fascinating market out there. Right. That's what I want to say. I do want to come back to the pound yen because we've had some nice moves on there. And I want to have a look at the daily chart in particular, because with the daily, we've had some really nice clues as to what is likely to happen in the following day, as it were, to give us a kind of, not a bias exactly, but maybe some insight into where the price may be going. So if you've got any questions on anything I've said, please just drop them into the chat box. Happy to answer them. I'll pass over to David and I will be back later.
Hi, everybody. Hopefully you can hear me okay. Thanks, darling. And you should be able to see my screen as well. I'll be rapid because I want to cover several things in the next sort of 10 minutes or so, and then I'll pass back to Anna. I'm starting with TradingView. I've got NinjaTrader up as well. I'm starting with TradingView. And the reason I'm starting here is because it's a nice, easy way for me to show you several things. First of all, the new indicators, which are on the top line. These are the scripts that we currently publish for TradingView, and there are 24 of them, which really gives you an indication of how rich and deep the full package is now, because these have been added in. So if you're an existing TradingView full package customer, or you're on the education program using TradingView, you will have got these indicators. If you haven't, please just drop us a line at helpdesk@quantumtrading.com, and the guys there will sort you out. So these are the three new indicators: the market strength, the VRSI, and the VWAP Pro. And in addition to that, they are also on NinjaTrader, so the same applies there. And I know we are constantly asked in the VPA forum particularly, and also on email, will these be available for TradeStation? Will they be available for MT4, MT5? The short answer is yes. We haven't done the coding yet. I don't see a reason why they can't be incorporated into those platforms. Certainly, TradeStation won't be an issue. We occasionally have issues with MT4 with the meta quotes, but in this case, I don't see a major issue. So I'm sorry it's taken such a long time, but as Anna said, we've been working on the stock program, plus we've been doing all this other stuff as well, which has all taken a while to get together. So those are the three new indicators. And what I wanted to remind you of, and also remind me to mention, this is an existing indicator. It's one we don't focus a great deal. It's the crypto currency strength indicator. And the reason I've got it up, several reasons. First of all, to illustrate the fact that we actually have three strength indicators now. If I just go on to the next workspace here, we have the market strength indicator, which is the one on the left and the one on the right. So that's very much for indices, for stocks, for commodities. You can use it pretty much on anything you like, works in all the various timeframes, as you would expect. And in the center there, we've got a very well-known currency strength indicator. So those are two of the strength indicators that we now have. And to that, obviously, we have this one, which has been around a couple of years now, I think, the quantum cryptocurrency strength indicator. So we've essentially got three. We have three strength indicators. And as you can see, they all work in a very similar way. They work on overbought and oversold regions. The nice thing with the crypto version is that, unlike the currency version where you will get divergence between the various currency pairs, so you'll get some pairs rising, some pairs falling, some pairs going nowhere, what you see in the crypto world is a very different scenario where everything is based against this red line here, which is tether, which is tethered, excuse the pun, to the dollar. And then all the other cryptos down here. So you've got Bitcoin, Ethereum, and all the rest of XRP. And the nice thing with the crypto world is that the cryptos tend to move en masse, as you can see here. I've got a 135 combination here. But you can see once they start to move, typically they will move en masse together. And then obviously tether, which works inversely, will go in the opposite direction. So that's just a facet of the crypto world. Now, the other reason I mention the cryptocurrencies in amongst the Forex world is because on the Forex trading program, for those of you who are on it, you'll be well aware that we have a funded Forex program. That is not available. All the details are still there, but over the last few weeks, we've been working on updating that, and in several different ways. I won't go through all the variations, but first of all, we are broadening it out. So rather than have a starting point of 5, 10, and 15, we're actually moving to a model where we've introduced 1. So you can start with 1,000, very, very comfortable, very low level. We've got 1, we've got 2.5, 5, 10, 15, and then at the top end, we've added 20,000. So we've really broadened that out away from the 3. We've gone to 6. So that's the first big change. The second big change is we've simplified down a lot of the rules and regs surrounding it. Again, I'm not going to go through it here because there are too many to go through, but we are in the process of getting that all updated. It's much, much simpler. 2 key points. First of all, the floor of risk is very much simplified. So it was a little bit complicated before. It's very simple now. Targets are very clear. Floor of risk is very clear. And the other big change is that whereas before on an evaluation starting account, you could only trade the 28 currency pairs, and hence my reason for a rather long-winded way of coming back and linking it to cryptocurrencies is that within the starting level at the evaluation level, you can now trade, and forgive me if I do get this wrong, but we're just putting it together now. You can trade cryptocurrencies, you can trade the 28 currency pairs, you can trade a huge number of indices, which we've opened up to really cover pretty much the world, whereas before we were more or less restricted to, I guess, US indices, the 3 sort of primaries. Now you can pretty much trade all of them wherever you are in the world. The global indices are available. And in addition to that, we've also got some commodities in there, oil, gold, silver, and possibly one other. So that's the reason I wanted to really tie it all together and bring cryptocurrencies in at this point, but also to highlight the fact that we now have these 3 these 3 strength indicators, which all work in a very, very similar way. The currency strength indicator, which you're all, I'm sure, familiar with, but we now have the market strength indicator, which really addresses the whole issue of stocks. So you can put cash markets in there, you can put ETFs in there, you can put indices in there, you can put commodities in there, you can put bonds in there. It really doesn't matter. And they will work in exactly the same way, where you can interpret very much intraday what is going on, overbought, oversold, is something rising strongly, falling strongly, how is it correlating against another stock, what's the relationship with the indices or the particular index that stock is in. So again, it's very much along those strength lines. Now I can pause at that point and maybe pass back to Anna if she's ready. I've got other things here that I do want to go over as well. I've got the Renko here on the Time Accurate, which I'd like to cover in a little bit more detail. And I've got some other workspaces here set up with the new indicators too. But let me pass back to Anna at this point, and then she can go into the dollar and other bits and pieces, and then we'll come back over here maybe to wrap up, something like that.